If you receive a pension, the tax rules can affect you very differently from many other retirees in America. Different from someone with only a 401k. Different from someone living mostly on Social Security. Different from someone relying on a regular brokerage account. And many people, including plenty of tax preparers, do not fully understand what that can mean for your retirement tax bill. Here is what I want you to consider for a moment. Only a small percentage of private sector workers still have access to a traditional pension. A much larger share of state and local government workers do. So, if you are watching this video and you have pension income coming, you are part of a very specific group. The strategies that work for everyone else, the rules of thumb you see in retirement books, the 4% rule, the usual withdrawal order, almost none of it was designed around you. I am going to walk you through 6 ways pension income can change your tax picture that many people are not discussing. By the end of this video, you will understand why your pension can change the math on Social Security taxation, Roth conversions, Medicare premiums, state taxes, required minimum distributions, and the lump sum versus monthly payment decision that too many people make without seeing the full picture. But before I get into it, I want to ask you something. Drop a comment right now and tell me one thing. Do you have a pension coming, or are you already receiving one? Just yes or no. The reason I am asking is because the comments on this video will help me decide which version of this content to make next. If most of you are still working and trying to plan ahead, that is one video. If most of you are already collecting and trying to adjust, that is a different video. So, just drop yes or no in the comments. 2 seconds. I read every single one. Before I go any further, I need to be clear. I am not a lawyer. I am not a CPA. I am not a financial advisor. Nothing in this video is legal, tax, financial, or investment advice. These are educational examples based on current tax rules and publicly available information. Always speak with a qualified tax or financial professional about your own situation. My name is Ivy, and if this is the first video of mine you are watching, this channel is for one specific group, retirees and pre-retirees over 60 who want to understand how taxes can work in retirement. Not the version you heard casually at work, not the version your neighbor with strong opinions mentioned over the fence. The practical version with real numbers explained in plain English. If that sounds like you, hit subscribe right now, because what I am putting out next week is going to be one of the most important videos I have made on this channel. Now, let us start with the thing that surprises pension holders the most. The first major issue is that pension payments are often taxable as ordinary income. In many cases, every single dollar is taxable. People do not always realize this. They assume that because they contributed during their working years, the payments they receive later will come back at least partly tax-free. That is not how it works for many pensions. If your pension was funded with employer money and pre-tax contributions, the payments you receive in retirement are generally taxed as ordinary income at your federal marginal tax rate. Not capital gains rates, not a special pension rate. Ordinary income, similar to how wages are taxed. If you contributed after-tax dollars to your pension while you were working, a portion may come back tax-free using rules such as the simplified method. But for many public sector pensions and many private pensions, the tax-free percentage of each payment may be relatively small. Here is what that means in practical terms. Say you receive $36,000 a year from your pension. If you assume that money will hit your bank account untouched, the way many people mentally think about Social Security, you could be surprised. At a 12% federal bracket, that could be roughly $4,300 going to federal tax. At 22%, it could be closer to $7,900. And that is before state taxes are considered. Which brings me to the second major issue. Your state of residence can matter a great deal when it comes to pension income. Many retirees think about state taxes mainly by asking whether their state taxes Social Security. Some states still do, but pension income can be treated very differently from Social Security at the state level. And the differences can be huge. Pennsylvania, for example, generally does not tax many retirement pension distributions. Illinois also has broad retirement income exclusions. Mississippi excludes certain retirement income. New Hampshire, Florida, Texas, Tennessee, Nevada, and several other states do not have a broad wage-style state income tax. Compare that to California, where pension income is generally taxed as ordinary income at the state's regular rates. Or New York, where certain pension income may receive an exclusion, but amounts above the applicable exclusion can still be taxable depending on the type of pension and the taxpayer's situation. Or Minnesota, where pension income can remain taxable with limited deductions or exclusions. If you have a pension of $40,000 per year, the difference between living in a high-tax state and a state that excludes that pension income can add up quickly. Over a long retirement, that difference may become tens of thousands of dollars. Same pension, similar lifestyle, different state, very different after-tax income. The third major issue is that pension income can change how much of your Social Security becomes taxable compared with someone who does not have a pension. This is the part that many people never hear explained clearly. The IRS uses something commonly called provisional income to determine how much of your Social Security benefit is included in taxable income. Provisional income is generally your adjusted gross income, plus tax-exempt interest, plus half of your Social Security benefits. If you are a single filer and your provisional income is below $25,000, your Social Security benefits are generally not federally taxable. If it is between $25,000 and $34,000, up to 50% of your benefits may be taxable. Above $34,000, up to 85% may be taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000. Now, here is the part many people miss. Pension income generally counts toward your provisional income, dollar for dollar. There is no broad pension exclusion for this calculation. So, if you have a pension of $30,000 per year, your provisional income may already start at $30,000 before you withdraw anything from your IRA, before you add half of your Social Security, and before you count any interest from savings. What that means is many pension holders can end up in the range where up to 85% of Social Security benefits are taxable. If you have a $30,000 pension and collect $24,000 in Social Security, half of that Social Security is $12,000, bringing provisional income to $42,000 even with no IRA withdrawals. That puts a single filer above the $34,000 threshold, meaning up to 85% of Social Security may be taxable. That could mean $20,400 of your benefit is included in taxable income. Compare that with someone who has no pension, has the same $24,000 Social Security benefit, and pulls money from an IRA only when needed. That person may have more timing flexibility. They may withdraw less from the IRA in certain years. They may plan Roth conversions more carefully. They may manage provisional income more actively. With a pension, your payment usually arrives every month whether you want the taxable income that year or not. The thresholds were created decades ago and have not been indexed for inflation. Many pension holders cross them automatically. Quick break. I want you to drop another comment. Tell me, did you know your pension could push more of your Social Security into the taxable zone? Yes or no? I am genuinely curious how many people watching this had no idea. The comment section is where I learn what to teach next, so please tell me. The fourth major issue is that pension income changes the math on Roth conversions in ways that can still help pension holders if they understand the trade-offs. A Roth conversion is when you move money from a traditional IRA, pay tax on the converted amount now, and place it into a Roth IRA, where qualified withdrawals can be tax-free and Roth IRAs do not have lifetime required minimum distributions for the original owner. For many retirees, the best time to do conversions is during the gap years between retirement and the age when RMDs begin. Those years are often lower income years, but many pension holders do not have the same low-income gap years. The pension starts. The income is steady. There may be no low-income window to use. So, conventional Roth conversion strategy may say you missed the best window. The pension may keep you in a higher bracket. So why convert at 22% or 24% when another retiree might convert at 12%? Here's the counterintuitive part. For pension holders, Roth conversions can still make sense, but the reason is different. The reason is not always that you are converting at a low tax rate. The reason may be that your pension has already created a higher income floor, and future required distributions could make the situation harder. When required minimum distributions begin, those RMDs stack on top of your pension. Your pension does not stop. Social Security does not stop. Your RMDs are based on your traditional IRA or 401k balance and the IRS life expectancy tables, and the percentage generally rises as you get older. By age 80, you may be required to withdraw a meaningful percentage of the account each year, whether you need the money or not. At older ages, that required percentage continues to increase. If you have a pension of $30,000, Social Security of $24,000, and a traditional IRA worth $400,000, your RMDs at age 73 could start around the mid-teens in thousands of dollars. By age 80, with market growth, they could be much larger. Add it together, and you may be looking at $60,000 to $70,000 of taxable income each year, much of it arriving whether you plan to spend it or not. That is the trap. Pension holders may need to think about Roth conversions not simply as a way to fill low brackets, but as a way to reduce traditional IRA balances before future RMDs create an even bigger tax problem. Converting $20,000 a year in your 60s at 22% may feel painful. But being forced to take larger distributions in your 80s while also receiving a pension and taxable Social Security may be even more difficult. The math may favor paying some tax earlier while you still have more control. The fifth major issue for pension holders is the way Medicare IRMA surcharges can affect you. IRMA stands for Income-Related Monthly Adjustment Amount, and it is an additional Medicare premium amount that applies when your income crosses certain thresholds. For a single filer in 2026, if your modified adjusted gross income from 2 years earlier is above $109,000, you may pay an additional amount for Medicare Part B and possibly Part D. For married couples filing jointly, the first threshold is $218,000. The standard Part B premium in 2026 is $202.90 per month. With the first IRMA tier, the monthly cost increases. At higher tiers, premiums can be substantially higher per person. Here is why pension holders need to pay attention. Your pension is income that you generally cannot turn off. It contributes to your modified adjusted gross income every year. If you also have a significant 401k or IRA, and if you do a Roth conversion in any given year, that conversion is added on top of your pension and Social Security for income purposes. It can be easy for a pension holder doing a normal-sized Roth conversion to accidentally cross an IRMA threshold. The 2-year look-back is what makes this tricky. Medicare generally uses income from 2 years earlier to determine today's premium. So, a conversion you do in 2026 can affect your Medicare premiums in 2028, potentially by hundreds or thousands of dollars for that year, depending on your income and tier. Pension holders need to plan conversions with one eye on the federal tax bracket and the other eye on the IRMA tier they may be approaching. Many people do not run this calculation. Many retirees do not know it exists. If you are a married couple with combined income from pensions and Social Security near $190,000 and you are considering a $40,000 Roth conversion, you need to know that it could push you over an IRMA threshold and increase Medicare premiums in a future year. That is real money in addition to the conversion tax. The strategy might still make sense, but you need to understand the full cost. Now, before I get to the sixth and biggest one, I want to do something. If you have made it this far in the video, you are exactly the type of person this channel is built for. Hit the like button. It takes 1 second and tells YouTube to put this video in front of more pension holders who need to hear it. And if you have not subscribed yet, do it now. I make videos like this every week, and I do not want you to miss the next one. The sixth and biggest issue for pension holders is how your lump sum versus monthly pension decision can affect your taxes and flexibility for the rest of your life. When you retire from a job with a pension, you may have a choice. You can take a monthly payment for life, often with a survivor benefit option for your spouse, or you may be able to take a lump sum, roll it into an IRA, and manage the money yourself. Many financial channels treat this mostly as an investment math problem. Which option has the better return? How long must you live to break even on the monthly payment? But the tax angle on this decision is often overlooked, and it can be huge. If you take the monthly pension, the taxable portion of every payment is generally taxed as ordinary income each year for as long as you receive it. That income is locked in. You cannot usually defer it. You cannot usually accelerate it. You cannot easily skip it. It arrives year after year and may be taxable year after year. If you take the lump sum and roll it into a traditional IRA, you may create much more tax timing flexibility. You decide when to withdraw, you decide how much, you decide which year to consider a Roth conversion. You may manage provisional income. You may try to stay below IRMA thresholds in lower spending years. You may accelerate withdrawals in years when deductions are higher. You may do things that monthly pension holders cannot do because their income is fixed. But, and this is important, The lump sum is only potentially better if you actually use that flexibility wisely. If you take the lump sum, roll it into an IRA, and then take regular monthly distributions exactly like the pension would have paid you, you may have given up the certainty of the pension without receiving much tax benefit. You took on investment risk, you took on longevity risk, you took on the responsibility of managing the money, and you did not capture much of the tax timing flexibility that was the main advantage. The lump sum decision is not only about returns, it is about whether you are willing and able to manage the tax timing of those dollars for the rest of your life. If yes, the lump sum can be valuable for some people. If you are simply going to leave it alone and withdraw a steady amount every month, the monthly pension may be the stronger choice for many retirees because it reduces investment risk, reduces longevity risk, and may produce a similar tax result to an unmanaged lump sum. There may also be a hybrid option that many people never ask about. Some pensions allow a partial lump sum and a partial monthly payment. This is an option many pension holders should at least evaluate. Take part of the value as monthly income to help cover fixed expenses such as housing, utilities, food, insurance, and basic transportation. Take the rest as a lump sum to create tax flexibility for other needs and goals. You get some security from dependable income and some tax control from flexible assets. Many people do not even know this option exists. Ask your pension administrator. Now, let me bring all 6 issues together because they interact in ways that make pension planning very different from non-pension planning. Your pension may be fully taxable as ordinary income, so federal taxes can affect you more than expected. Your state of residence can dramatically change the after-tax value of your pension, sometimes by tens of thousands of dollars over retirement. Your pension can push more of your Social Security into the taxable range in many cases. Your Roth conversion strategy is different because you may not have low-income gap years, but you may also face a bigger RMD problem later if you do nothing. Your Medicare IRMA exposure is ongoing because your pension creates a permanent income floor, and any conversion or withdrawal stacks on top of it. And your lump sum versus monthly decision should be based partly on whether you will actively manage tax timing, not just on rate of return assumptions. Here is the practical reality. If you are a pension holder, the standard retirement playbook may not fit you. The 4% rule was not written for someone whose guaranteed or dependable income already covers much of their spending. The standard Roth conversion ladder was not designed for someone whose income floor is permanently higher. A basic Medicare premium estimate may not warn you how easily you can cross IRMA thresholds. Many state tax comparisons focus on Social Security, not pension income. You need a different framework. And the foundation of that framework is something many financial planners call asset-liability matching. Match your fixed expenses, such as housing, utilities, food, insurance, and basic transportation, with your fixed or dependable income, such as pensions and Social Security. If your dependable income covers most of your fixed expenses, your investment portfolio may be able to serve different purposes. It may not need to be overly conservative. It may not need to produce current income. It may be positioned for growth, legacy, or opportunity because your basic lifestyle may already be supported by the pension and Social Security. Let me give you a hypothetical example so you can see the framework in action. Imagine a couple, both age 66. The husband retired from a state government job last year. His pension pays $36,000 a year with a joint and survivor option. Their combined Social Security is $40,000 a year. Their fixed expenses, once they sat down and added everything up, were $68,000 a year. Housing, utilities, food, insurance, basic transportation, healthcare premiums, that is it. Their dependable income is $76,000, and their fixed expenses are $68,000. They have an $8,000 cushion before touching a single investment dollar. That changes everything. They have $450,000 in a traditional 401k that they have been keeping in a target date fund. 60% stocks, 40% bonds, the default. The moderate path many advisors recommend broadly, but they may not need that account for basic survival. Their pension and Social Security cover their fixed life. The 401k is for travel, gifts to grandchildren, an occasional vehicle, and a buffer against unexpected care needs. Those are goals and contingencies, not basic monthly necessities. Money earmarked for goals may be able to take more risk because if the market drops 30%, they may delay a vacation. They do not immediately lose the ability to pay the mortgage. For them, it may be reasonable to discuss a more growth-oriented allocation in the 401k with a qualified advisor. Their pension is functioning like a large fixed income asset in the overall household picture. Adding too much additional conservatism inside the 401k may be double counting safety and limiting growth they may need later. Now add the tax strategy. They are 66. They have several years until RMDs begin at age 73 under current rules. During those years, they may want to evaluate strategic Roth conversions each year. Not because they have truly low-income gap years. They do not. But because RMDs at age 73 on a growing $450,000 account could become difficult. If that account grows significantly by age 73, the first RMD could be tens of thousands of dollars, fully taxable on top of pension and Social Security. Converting a measured amount each year may cost tax now, but it can reduce the future RMD pile over a long retirement. That kind of planning may save meaningful money depending on future tax rates, investment returns, state taxes, Medicare premiums, and life expectancy. The conversion can feel painful in year 1. It may become more valuable by year 10. It may be a gift to your future self at age 85. This is the part many pension holders miss. They have dependable income covering their needs, and they still keep their 401k in conservative balanced funds, treating it like the only safety net. It may not be the safety net. The pension may be the safety net. The 401k may be the opportunity fund, the inflation hedge, and the flexibility bucket. Pension holders can sometimes afford to be more growth-oriented with part of their investment portfolio than retirees without pensions because they are not relying on that portfolio for every grocery bill. There is one more part of this puzzle that many people do not model carefully, and it has to do with your spouse. When you elect your pension, you may have a choice between single life, which pays more per month but stops when you die, and joint and survivor, which pays less per month but continues some benefit to your spouse for the rest of their life. Many people make this decision based mainly on the monthly payment difference. They take the higher single life payment because it appears to be the better deal on paper. But you must run the numbers on what happens to the surviving spouse. When one spouse dies, household expenses usually do not fall by half. They may fall by 20% to 25%, sometimes less. The mortgage is the same. Utilities are often mostly the same. Insurance and property taxes may be similar, but the household loses one Social Security check. And if you elected a single life pension, the entire pension may stop as well. So the surviving spouse can be left with 75% of the previous expenses and far less than the previous dependable income. That gap can create serious hardship. I have seen widows who were financially comfortable while their husband was alive, and within a few years of his death, they were pulling large amounts from a 401k that was never intended to support one person alone for decades. Choosing a single life pension simply to maximize monthly income while both spouses are alive can be one of the most consequential mistakes pension households make. And it is often made without modeling the survivor scenario. If you are married and have not retired yet, model this. Take your fixed expenses, reduce them by about 25% as a starting estimate. That is a possible surviving spouse expense floor. Now look at what dependable income would remain if you died first. The surviving Social Security benefit plus whatever pension survivor benefit you elected. If that number is well below the expense floor, the joint and survivor election may deserve serious consideration. Even though the monthly payment is lower while both spouses are alive, you may be buying protection for the most vulnerable years of your spouse's life. There is also the inflation problem that pension holders need to take seriously. Many private sector pensions and some public sector pensions do not have a full cost of living adjustment. The $36,000 a year you receive in year 1 may be the same $36,000 in year 10, year 20, and year 30, while the cost of everything around you keeps rising. At 3% annual inflation, $36,000 of today's purchasing power is worth much less in 10 or 20 years. That erosion is quiet at first. Year to year, you may barely feel it. But by retirement, year 15 or 20, the gap between what your pension pays and what you need to maintain the same lifestyle can become substantial. This is why the 401k or IRA balance remains critical, even for people whose pension covers current expenses. The investment portfolio is not only for wants. It may also be inflation defense, gradually bridging the widening gap between fixed pension income and rising real expenses. Social Security has a cost of living adjustment built in. Many pensions do not, or they have limited adjustments. So the longer you live, the more your overall dependable income may shift away from being pension dominant in real purchasing power and towards Social Security. Plan for that. Do not assume your age 65 budget will work at age 80 without inflation-adjusted withdrawals from somewhere else. Once you understand that, every other decision changes. Roth conversions become a tool to reduce traditional IRA balances before RMDs become larger. Strategic withdrawals become about managing tax brackets and IRMA tiers, not merely hitting a 4% withdrawal rate. State residency becomes a serious financial decision because the math can differ from non-pension households. The lump sum versus monthly decision becomes about whether you have the discipline, support, and planning process to manage tax timing, not just about investment returns. Last thing before I let you go. If you have a pension, one of the most expensive mistakes I see people make is doing nothing. They retire. They start taking the pension. They assume the tax situation will work itself out. And years later, they may be paying taxes or premiums that could have been reduced with better early planning. The IRS does not send you a letter saying you might have structured things more efficiently. The system simply calculates what you owe. So, here is what I want you to do. First, if you are still working, find out what choices you actually have for your pension. Single life, joint and survivor, lump sum, partial lump sum, and cost of living features. Most people never ask enough questions. Ask. Second, if you are within 5 years of retirement, consider sitting down with a fee-only financial planner or qualified tax professional who understands pension taxation, not a salesperson. Bring your pension statement, Social Security estimate, IRA and 401k balances, and your state of residence. Ask them to model the next 20 years, not just the next 2. Third, do not assume your tax software is evaluating every long-term planning issue. Many consumer tax programs are built for annual tax filing, not for modeling the interaction of pension income, Social Security taxation, RMA thresholds, and Roth conversion strategy over decades. Ask specifically. And here is the comment I really want from you on this video. Tell me which of the 6 things surprised you the most. Was it the state tax difference? Was it the Social Security taxation issue? Was it the IRMA exposure? Was it the lump sum strategy? Whatever it was, drop the number in the comments. Just the number 1 through 6. That number tells me exactly what to cover next. And the most common answer may become next week's video. If this video helped you, hit the like button. If you have a friend, spouse, sibling, or anyone about to retire with a pension, send them this video. A little planning now may save them a meaningful amount of money and years of stress. And if you are not subscribed yet, do it now, because the next video I am making is for the exact people who answered yes to my first question. People who have a pension coming and want to plan correctly before it starts. I will see you in the next The US Guide.